This video is sponsored by Blinkist. The first 100 people to go to blinkist.com/theplainbagel will get 1 week for free plus 25% off a full year subscription. As investors, it's obviously difficult to weather market crashes like what we've seen so far in 2020. Watching your portfolio drop 10% or more in a single day is enough to make even experienced investors a little anxious. It's for this reason that it's beneficial for most people to focus their strategy on the long term. With markets being so volatile on a day-to-day basis, it's easiest to pick companies that you're confident will be around and stronger once this all blows over. But how can you tell if a company can indeed weather this? After all, during the tech crash in the 2008 financial crisis, we saw a number of seemingly promising businesses go bankrupt. So while we shouldn't put too much emphasis on short-term headwinds, anything that threatens the very existence of a company should be taken seriously. So let's go over how to gauge the risk of your holdings in this downturn on today's Plain Bagel. I want to preface this video to explain that what I'm going to share isn't some surefire formula for picking stocks. Indeed, positions that meet these criteria may do poorly over the next little while, and companies that violate some of these points may do very well. The point of this checklist is to help you gauge the risk of your holdings during a downturn and to identify red flags so that you can adjust your portfolio to your risk tolerance. If you find you have some high-risk plays in your account, it may not be a red flag if you're well diversified. But if all your money is tied up in just a few risky firms, you might want to reconsider the diversification of your holdings. I also want to highlight that in addition to these factors, there are a lot of company, industry, and event-specific details that will influence how a stock handles this downturn. For example, with the current COVID-19 pandemic, some companies are going to have a much harder time simply because of the products and services they offer and the specific nature of this downturn. So while we'll be focusing on industry agnostic factors to consider, you should also take this information into account as well, as it could very well determine whether a company survives or not. But with all that being said, let's go over 4 areas you need to look at to understand how well equipped your holdings are to weather and handle an extended period of lower revenues. The first of which is the company's profitability. This may seem like a no-brainer, since over time companies have to make money to survive, and indeed that's where a lot of the value for their stock itself comes from. But leading up to this downturn, we had a lot of popular companies that were in the red. This doesn't necessarily mean they were bad businesses, but it does put them in a bad spot. You see, companies that are experiencing high growth will usually spend more than they make up front to help build out their production and to expand their consumer base through marketing, a strategy that's worked wonders for companies like Amazon. The funding for this spending usually comes from investors in the form of equity and debt. And when times are good, this money is pretty easy to come by. But when we see stock markets fall and fears of a recession grow among investors, the market often becomes less forgiving of loss-generating firms, and investors become less willing to fund the expenditures of startups, putting these companies at risk of running out of money. So it's worth seeing whether a company is profitable, and if they are, take a look at their margins. A profit margin is equal to the company's earnings divided by their revenue, and the bigger the margin, the better. Now, unfortunately, different industries use different measures of profitability when analyzing a company's margins. For retailers, a simple net income margin from their income statement may suffice, but real estate companies use measures like net operating income and funds from operations. So keep that in mind when you're going through your companies and determining how profitable they are. You should also check a company's cash flows to make sure the money that they say they're earning from operations is actually entering their bank account. After all, when bills come due, it's a company's cash balance that keeps the collectors at bay, not the accounting estimate of their gains or the value of their assets on their balance sheet. Secondly, a really important factor to consider is the company's war chest, how much money they have put aside and available to help them through a downturn. In more technical terms, this refers to a company's liquidity and access to capital. Liquidity just refers to the amount of money the company can quickly access. You can think of it as the size of the company's rainy day fund. It typically includes cash balances and short-term investments, which you can find in the current assets section of a balance sheet. It's also worth considering the money the company can quickly borrow from banks. For example, in a company's regulatory filings, you can find disclosures about unused or available lines of credit or revolving credit facilities. This is money they've been pre-approved to borrow and spend. And if these companies face a temporary drop in their cash flows, it can help them bridge the gap and continue paying bills until things recover and they start making money again. To gauge liquidity, you can use ratios like the current ratio, quick ratio, or cash ratio. These ratios all follow the same premise, but each one is slightly more strict in their definition of liquidity than the previous. The current ratio is simply a company's current assets that can be converted to cash within the next 12 months, divided by the current liabilities, amounts generally owed over the next 12 months. And it shows whether the company can roughly meet their short-term obligations. The quick ratio takes the same measure, but excludes some current assets, like inventory, from the calculation, since these items may be hard to liquidate in a downturn. And the cash ratio only compares current liabilities to cash and short-term investments the company has on hand. During a crisis, the cash ratio is the most conservative one to consider, since it doesn't rely on the solvency of third parties. But all three have merits in gauging the liquidity of a company. You should compare the metrics to peers as well as historical values for a company to see where they stand. Third of all, we of course need to understand a company's debt. Debt is something that can be very useful to corporations to leverage their growth and boost profits. But being over-levered increases the risk of a company going under and out of business. After all, a company with no debt and a flexible business can essentially hibernate through downturns and simply resume operations once things recover. But levered companies have interest payments they need to meet, and if they default or miss one of those payments, there are severe ramifications. Unless the company files for bankruptcy protection, which alone can crash the stock, or reaches an agreement with its bondholders, creditors will have the right to demand the company liquidate its assets so that they can recover their principal from the proceeds. And once bondholders have had their pickings, there's rarely much left for shareholders to recover their own capital. Now, low interest rates have made debt more affordable to companies, and the recent rate cut has extended that. But it's likewise encouraged companies to take on more debt than necessary. So with our current predicament, it's something worth scrutinizing. Now, you can gain a quick understanding of a company's debt position by observing three main items: their debt balance, their interest payments and the interest rate, and their covenants. The debt balance is how much principal they owe to their creditors. And aside from just looking at the number as a whole, which doesn't mean much on its own, there are a few ways to gauge how much a company has borrowed. A simple one is to take the company's debt balance and divide it by the total value of assets on their balance sheet. Net debt to EBITDA, or earnings before interest, tax, depreciation, and amortization, is another handy ratio, but one that will be impacted if business activity falls. Secondly, the interest rate is the annual percentage of the debt balance a company has to pay to creditors on a regular basis. Management will often disclose the company's weighted average interest rate in their filings, but you can also refer to the dollar interest expense reported by the company in their income statement. With this figure, you can calculate the interest coverage ratio, which will show you how many times a company's operating profit covers their interest obligations. But again, profits may fall in a downturn and deteriorate this ratio. Finally, as you're probably aware, many debt arrangements require a company to meet certain operating criteria to make the loan safer for the lender. These are known as covenants. A bank, for example, may require that a company keep its net debt to EBITDA ratio below 5 times. If earnings fall, we could see the company's ratio rise above this amount, and this could have a number of consequences. A company may be forced to immediately pay back its debt balance or start paying a higher interest rate. Regardless, it's something we'd want to avoid during a crisis. So if you invest in companies with debt, take some time to understand their covenants and how much wiggle room they have in meeting these criteria. A company well within their covenants will be in a better position going into a downturn than a firm that's already close to violating their terms. Finally, the fourth factor to consider to gauge a company's tenacity through this downturn and future ones is their fixed costs and commitments. While debt is usually the first thing investors scrutinize about a company during a downturn, a company can still go out of business if they have other fixed costs they need to meet without the necessary revenue streams. The best example of this is the lease. A lease is an agreement a company enters whereby they pay someone to use or borrow their land, buildings, or equipment, much like when you enter a lease for an apartment. While leases make it easy for companies with fewer assets to run a business, they too come with ramifications if you miss a payment. For example, a lessor may demand the assets be returned, or even pursue litigation to recover the remaining balance owed on the lease. This is something that could cripple operations and even force a company to shut down. Companies may also have other unique commitments that don't show up explicitly on their financial statements. For example, an airline company may have a derivative agreement whereby they've agreed to purchase $5 million worth of jet fuel in 2020. But with many planes currently grounded, companies with no use for this will still need to cover those obligations. So it's worth going through a company's commitments and contingencies, which you'll find in their regulatory filings. And if you can extract a company's fixed costs from their income statement, you can calculate the fixed cost coverage ratio to see how well covered the company's expenses are. So those are the 4 things to consider when gauging a company's tenacity through this downturn: profitability, liquidity, debt, and other fixed costs and commitments. Of course, this in no way will give you the whole picture of how a company will handle this current downturn, nor will it tell you how a stock will perform moving forward. There are also a lot of unknowns that could influence individual companies that we simply can't account for in our research. So it's impossible to predict who will falter and who will come out on top. That being said, there is no excuse for turning a blind eye to what we can know about our holdings. If you want to allocate some of your portfolio to a riskier company you have faith in, by all means, but be aware of their financial position going into this. Not only will this help you identify red flags, but it should give you peace of mind through market volatility. After all, if you understand the quality of your holdings, it's a lot easier to stand by them when prices fall 10, 20, 30% or more. As I'm sure you know, one of the best ways to learn about finance is by reading. Many great investors have written books sharing their wealth of knowledge, and there's a lot to be learned from them. I've personally made sure to get through a number of titles, but between studying, making these videos, and working full time, I haven't had much downtime to really explore everything out there, which is why I think today's sponsor offers a really cool service. Blinkist is an app that takes the key insights from thousands of books and condenses them into just 15 minutes that you can read or listen to. Books are also divided into short blinks, which are like mini chapters. So if you only have a few minutes, you can still learn something new. For example, I recently listened to Crashed by Adam Tooze, which talks about how the 2008 financial crisis influenced both the world economically and politically up to present day. They also have The Intelligent Investor on there, which was a nice refresher of the key lessons from the book. But if you're looking to take on the value investor's rite of passage to get through the actual text, you can do that too, thanks to Blinkist's new audiobook section, where members can pay a discounted price to listen to full texts like The Intelligent Investor. But Blinkist's library goes well beyond investments, with topics covering everything from philosophy to health and nutrition. It's a service that's great for anyone with a busy schedule. And if you want to check it out, the first 100 people to go to blinkist.com/theplainbagel will get 1 week for free, plus 25% off the full membership fee. So if you're looking to expand your knowledge and support the channel, click the link in the description below and check out Blinkist. If you like this video, make sure to hit the like button. And if you like what we're doing here, make sure to subscribe. Hit the bell icon for notifications about future videos. If you have any feedback or topics you want me to cover in a future video, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today.